Bitcoin is once again under pressure. Prices are declining, market sentiment remains fragile. Headlines have turned increasingly pessimistic. Once again, critics are asking a familiar question. Is this the beginning of another prolonged Bitcoin bear market? However, while short-term price action suggests weakness, long-term institutional research presents a very different perspective. In a recent note to clients, analysts at Bernstein, one of Wall Street's most established research and brokerage firms, described the current downturn as the weakest Bitcoin bear case in history. Bernstein also reaffirmed its Bitcoin price target of $150,000 by the end of 2026. According to the firm, the present decline reflects a crisis of confidence rather than a failure of Bitcoin's underlying fundamentals. This analysis examines why Bernstein believes this bear market is structurally different, how institutional adoption continues to reshape Bitcoin's long-term outlook, and why concerns related to ETFs, artificial intelligence, quantum computing, miners, and leverage may be overstated. This is not speculative hype or short-term price prediction. It is a research-driven assessment of Bitcoin's evolving role in the global financial system. Bernstein's central argument is both direct and significant. According to analysts led by Gautam Shugani, Bitcoin's recent price decline is not the result of structural damage, systemic failure, or excessive hidden leverage. Instead, they characterize the downturn as a self-inflicted crisis of confidence. Historically, Bitcoin bear markets have been triggered by tangible structural events. These included major exchange collapses, excessive and hidden leverage, regulatory shocks, large-scale fraud, insolvency, and forced liquidations across the ecosystem. In contrast, Bernstein notes that none of the traditional catalysts associated with past Bitcoin downturns are present today. There has been no major exchange failure. There has been no systemic leverage unwind. There has been no widespread insolvency. There has been no breakdown of the Bitcoin network. Bitcoin continues to operate exactly as designed. Blocks are being mined consistently. Transactions are settling normally. Network hash rate remains historically strong. Infrastructure development continues to expand. Despite this, investor sentiment has turned sharply negative. Bernstein identifies this disconnect between fundamentals and sentiment as one of the most important characteristics of the current cycle. According to the firm, this bear market differs fundamentally from previous downturns due to unprecedented institutional alignment. For the first time in Bitcoin's history, the United States political environment has shifted toward greater acceptance of digital assets. Policymakers have become more openly supportive of digital innovation and increasingly critical of regulatory approaches that push the industry offshore. This shift has meaningful implications for capital markets. Bitcoin is no longer operating in regulatory uncertainty to the same extent as in prior cycles. Another structural change is the launch of spot Bitcoin exchange-traded funds. Spot Bitcoin ETFs have provided regulated, liquid access for pension funds, registered investment advisors, and traditional portfolio managers. They have integrated Bitcoin into mainstream financial frameworks and enabled institutional participation at scale. Once established, ETF infrastructure does not disappear during periods of low sentiment. Instead, it tends to accumulate exposure gradually as market conditions evolve. In addition, corporate treasury adoption has continued to grow. An increasing number of corporations now view Bitcoin as a strategic reserve asset, a hedge against long-term currency debasement, and a component of long-duration balance sheet allocation. This level of corporate involvement did not exist in earlier Bitcoin cycles. As a result, Bitcoin is no longer driven primarily by retail speculation. Bernstein also addresses the psychological dimension of the current downturn. The analysts argue that when adoption fundamentals appear strongest, market participants often manufacture fear. According to Bernstein, nothing has failed, no hidden risks have emerged, and yet confidence deteriorates. They attribute this in part to shifting attention toward new technological narratives, including artificial intelligence and quantum computing. In this environment, Bitcoin is frequently portrayed as outdated or irrelevant. Bernstein describes this as a recurring pattern. Bitcoin has repeatedly been declared obsolete or threatened, while simultaneously continuing to integrate into global financial infrastructure. Another commonly cited concern is Bitcoin's underperformance relative to gold during periods of macroeconomic uncertainty. Bernstein responds by emphasizing that Bitcoin is not yet trading as a mature safe haven asset. Instead, it currently behaves as a liquidity-sensitive risk asset that is highly responsive to financial conditions and interest rates. When liquidity tightens, capital tends to concentrate in assets such as gold, and Bitcoin underperforms. When liquidity conditions improve, Bitcoin has historically responded with outsized gains. According to Bernstein, the presence of ETF infrastructure and institutional capital channels positions Bitcoin to absorb future liquidity more efficiently than in any previous cycle. Concerns regarding Bitcoin's relevance in an increasingly AI-driven economy are also addressed. Bernstein argues that artificial intelligence strengthens rather than weakens the case for blockchain-based financial infrastructure. In an emerging agent-driven digital economy, autonomous software systems will require global settlement, machine-readable money, and programmable ownership. Traditional banking systems remain constrained by closed APIs, fragmented payment rails, slow settlement times, and jurisdictional limitations. Blockchain systems, by contrast, are open, programmable, and globally accessible by design. From this perspective, Bitcoin and blockchain infrastructure complement artificial intelligence rather than compete with it. Quantum computing risks are acknowledged but contextualized. Bernstein notes that quantum computing poses a challenge to all digital systems, including banking, government, military, and internet infrastructure. The transition to quantum-resistant cryptography will occur across the entire digital ecosystem, not uniquely within Bitcoin. Bitcoin's open-source architecture, global developer participation, and growing involvement from large, well-capitalized institutions position it to adapt alongside other critical systems. Concerns related to leveraged corporate Bitcoin treasuries and potential miner capitulation are also addressed. Bernstein states that major Bitcoin holding corporations have structured liabilities for long-duration exposure and stress-tested their balance sheets for extended downturns. One example cited indicates that Bitcoin would need to fall to $8,000 and remain at that level for 5 years to require major restructuring. Such a scenario is not considered a base case. Miners have also evolved significantly since earlier cycles. Many have diversified revenue streams, reallocated energy assets toward artificial intelligence data center demand, and reduced reliance on block rewards alone. As a result, forced selling pressure from miners has declined materially. Bernstein emphasizes that its